if you want to be a consistently profitable trader, then you have to do this one thing. And this is what led me to profitability. So in 2019, I actually lost my edge. I had an edge that I traded from 2016 to 2019. And then at the start of 2019, that edge completely diminished and I had no data. So I had absolutely nothing to fall back on. And from 2019 onwards, that led me down this data-driven trading path. Now, you can see even just this year, if we go back to January, this is every trade logged. Loads of different things I collected. I added some fields in February because I wanted to look at some other stuff. Logged again. March was the same thing. Collected loads more data. All of Q2, collected loads of data again. Q3 is in another spreadsheet. We are now in end of Q3 to Q4. And I moved to Notion. I do collect most of the data in Notion and in Google Sheets as well. So all this will be in a separate Google Sheet as well. But I find Notion is quite good to use because we can also add screenshots of the trades and stuff, which is perfect. But as a trader, your goal is just simply to do more of what works and less of what doesn't. And how do you know what works if you don't have this? If you don't have a collection of data on your edge? Now, it doesn't really matter what you trade. If we go to a chart, you may trade really complex systems. You may trade a Asia liquidity sweep, inverse fair value gap break. You may be on the 15-second time frame to confirm your entry. You may have a daily bias which you work out every day. It doesn't really matter. The thing for me is that although all those systems are complicated because they require a lot of fields in a table. For example, if you're trading a daily bias, if you're trading 1 minute confirmation, 15-second confirmations, liquidity sweeps, all this stuff, you need to be able to record all of it in a table. Not saying you can't do it, but it just means there'll be a lot of fields because you need all the basic fields that I have here, which are like time of entry, missed potential, drawdown in pips. I use cross-asset alignment, so you can see my plan literally is just summed up in a sentence here at the top, which is just mean reversion. So I trade supply and demand levels. Simple, I've shown that in loads of other videos. And I use cross-asset rotations. If you're not understanding market alignment, if you don't understand that the whole market is one entity and it moves in unison, it moves together, there's a link under this video. If you click that, you will get my alignment spreadsheet, my cross-asset rotation spreadsheet. Oh, it's a PDF in fact, but the PDF will show you exactly how you need to be aligning currency crosses, commodities, indices, and everything to understand how the market is moving. Now, all these metrics here are so important. I've taught hundreds of new traders, but all these new traders come from a point where they were focused on profitability. They were focused on the outcome. I just get my new traders to focus on data straight away. Their only goal is to fill out a spreadsheet every single day. Take the trades, fill out the spreadsheet. And what they find is that they become very process driven then, and the P&L just takes care of itself. Before they know it, they're a winning trader. Within 3 months, 12 weeks, they are a profitable trader because they focused on the process. And then all we need to do is look at that data, look at the spreadsheet they filled out, work out what's working, what's not, do more of what is, less of what isn't. Now, if we look at this, for example, this is my spreadsheet. I can tell you that for September, October so far, I have a 77% win rate. It's really important for me to put it all into a template like this, like Notion or Google Sheets, because I trade loads of different accounts, especially with prop firms and stuff. We might take some trades on one challenge, some on a verification, some on our live, some on our funded accounts. There's all different accounts going on. And using this method, it has allowed me to flip small money into big money. It's allowed me to get funded as a 6-figure trader. It's allowed me to be profitable and live full time as a trader. But all of this stuff is crucial. It's so important. And if you're not doing it, I fail to see how you're profitable if you're not doing this stuff. But equally, I fail to see how you can't be profitable if you are, because I can look at this data already for the last 2 months and I can see that my average missed potential per trade is 2R. Well, I'm always taking at least 1R on a trade. So that means most of my trades are doing 3. My average trades are doing 3R return. And my average drawdown in pips is 3.6. Well, a lot of my trades, I'm using a 15 pip stop loss, sometimes a 20. Is that really needed? This is telling me it's not, right? So that's how I do more of what's working and less of what isn't. And what's working right now is having a tighter stop loss and pushing my risk reward. Now, there's a couple of things with that, and I talk about that in terms of prop challenges and various other things. But if you look at this, you can see that if I was to trade a 1-to-1 85% win rate system, then my expected return over 20 trades could be 14%. This is obviously very variable and this will change on the data set, but this is what I'm interested in, my max losing streaks. So my typical drawdown over 20 trades is going to be 1 to 2% at 1% risk. Whereas if I trade a 1 to 2 system over 20 trades, my typical drawdown could be 4%. So double. And when we're trading prop firm challenges, we want to get them passed as quickly as possible. A higher win rate system is likely to be better than a lower win rate system, higher R. Now that doesn't account for trading your own accounts, trading personal funds, trading a fund, managing money, because if you're trading at 1 to 2 with a 65% win rate, so 20% less win rate, then we know that we are going to make more money. This particular example here made 25% more over the course of 100 trades. So over a bigger data set, higher risk reward is better, but a smaller data set, and that would typically be maybe 20 trades or less to pass a prop firm challenge and a verification or to secure a payout. We don't want to see these big consecutive losses, these big drawdowns. And what that data allows you to do is it allows you to assess whether you want to trade a system with a higher risk reward and look at trading prop firm accounts slower, maybe doing 0.5% risk, accepting that you're going to go through periods of drawdown, but eventually you will pass. And then over the long term, you will make good money. You will make a steady return. Or do you want to pass the prop firms quick? Do you want to gamify the system, trade them at 3% risk and get them passed? And then once you get them passed, then maybe consider increasing risk reward and lowering the win rate. But you have to understand, the lower your win rate, then the higher potentially your risk reward, but the more consecutive losses you hit. And that's really, really important. That's something I've focused on multiple times at expos, conferences where I've spoken, because people quite often don't have this data. And it's amazing how many people can't see this. What's your win rate? As soon as I work with a new trader and they tell me they have a system and they trade Asia liquidity sweep and they trade all this other stuff. Okay, my first question, what's the win rate? Can you show me your data? 8 out of 10 of them can't tell me their win rate. Probably another 1 out of 10 of them make it up. And then the rest of them tell me, but they don't have this. They just have their data collected at the bottom of their trade history, at the bottom of their account, right? But having taught loads of new traders, I know that the conviction comes from seeing the system work. And if you give a new trader a system with a high risk reward, lower win rate, and they hit 6 losses in a row, they lose confidence, they lose conviction in their edge. And this means that they don't then execute efficiently. All these basic things need to be quantified, like your time of entry, your miss potential, your drawdown. Alignment is a big one for me, because alignment is what I'm using for cross-asset alignment. Really simple terms. If I have a level on something like Australian dollar, US dollar, right? So let's say I'm looking at an area of supply. So next area of supply on this is here. So we have a clear area of daily supply. I could probably refine that on the H4. So let's say we refine it on the H4 to here. There's an area of supply on the H4. If I'm using cross-asset alignment, I know that these assets here, so NU, New Zealand dollar, US dollar, is likely to align. If it's moving with the dollar and the dollar's driving the move, then I know that New Zealand dollar and Aussie dollar are going to likely move together. They're going to move in unison. So if I had New Zealand dollar, US dollar hitting this area of supply at the same time, then that would give me alignment. And I just simply fill out this section to say, yes, there was alignment. Sometimes there isn't. There was 2 trades on Friday. They both worked. No alignment. There was actually a trade here on gold. So 20th of October, my biggest trades of the quarter. There's no alignment. Is that going to skew my data? Not really. It was a one-off. The trade was being driven by gold. I've covered this in another video as well. This was just simply this trade here. We had a clear area of H1 supply. Just there, we came down, we tapped back in. Really simple. That is about as simple as it gets for me. And I pushed that for 1 to 6. That was a unique scenario. We don't see trades like that every single week, every single month even. That was heavily overextended. It was due a correction, which I covered in my previous videos. Check that out if you're not sure what I mean by overextended, but it was overdue a correction. So the resulting move was a huge drop to the downside. But all that just goes in the journal still, and it forms a part of a larger data set. And that larger data set just tells us what we need to be doing into the next quarter. So I know that the distance to the first H1 level on that trade was a 1 to 2. I know that the distance to the first H4 level. So when I say H4, H1 level, I just mean area of first H1 supply or demand. Really, really simple. So first area of H1 supply actually could even be considered there, right? You know, there was an area of H1 supply, which we came up, we tapped straight back in, then we ranged. And then where was the first area of H1, H4 supply? It was here. It was just there. And I ended up taking the trade actually down to a moving average, which was something that I talked about in that previous video. But if you have all this data, if you have collected everything that you're looking at in terms of your edge, quantifying it, you don't have to use my edge. My edge is simple, and I lean towards simplicity because of the data. I don't want my edge to be so complicated that I have to scroll across 50 different columns to understand what I'm looking for. I just want a few basic tick boxes. Then I want to understand, you know, like here, I was looking at market environment through this quarter. So through Q2, was the market ranging or trending? Was I more profitable in ranging markets or trending markets? Well, actually, look, most of my losses came from ranging markets. There's one in a trend there, one in a trend there. So only 2 losses in trending markets there. All the rest were ranging, interestingly. You know, was the size of the zone, so this determined my stop loss, was it inside or outside the wick? So what do I mean by that? You know, really simple. If I was to take this trade here as a short, and I sold that level, and say my stop loss is here, then my stop loss is outside the wick of the zone. If my stop loss was here, it would be inside the wick, you know, and I'm measuring that metric based on, is it worth taking a trade if it's got such a big wick on the zone? Yeah, it was, because I went through that inside outside wick, made very little difference to my win rate. So overnight holds, you know, was there any overnight holds that resulted in losses? Is that something I need to be doing? You know, overall that was profitable, even holding overnight. So I continue to do that. Was the supply or demand zone visible on the daily time frame? Yes or no? You know, there's all these factors. And if you just quantify each one of them, you can start to figure out what works, what doesn't. It's really, really simple. And I would really encourage you guys to try to stick to a very basic system, you know, not something that's overly complex at first. Try and figure out whether you have a 50% win rate at 1-to-1. Just trade every trade at 1-to-1, 50% win rate. You don't need to be looking at the P&L at this point. You're just literally looking at your data. If you do that for 3 months, you do that for 12 weeks, you will be able to become a profitable trader. I mean, what is 3 months, 12 weeks in just your trading journey? You've probably been wasting years up till now not doing this and going around in circles, jumping from mentor to mentor, jumping from strategy to strategy, changing everything about your edge, you know, tweaking it, revenge trading, all the rest of it. You don't do any of that. If you have this data and you have a journal that you have to fill out, you also don't take shit trades, because you know that you've got to put it in your journal, and you feel like an idiot if you're having to put trades in your journal that weren't even part of your plan or that you shouldn't even be taking, right? So focus on the data, focus on building conviction in your edge, and then do more of what works, less of what doesn't. And if you need help with that, then you can use my edge. You can hire me as a mentor, and I will work with you for 12 weeks and get you profitable, guaranteed.